Hi everyone, we're Team Mind the Gap. I'm Garima and my teammates are Kritika, Malia, Neha and Shairi. We performed a comparative analysis of Macy's versus JCPenney. Both of these companies operate in the retail space. Let's start with Macy's. So Macy's Inc. is an American holding company and it owns department stores like Macy's, Bloomingdale's and Bluemercury. As of Q4 2016, the company operated approximately 829 stores in the United States, Guam, and Puerto Rico, and employed about 157.9K people. Macy's operates both retail stores and also has an internet website which specializes in the sales of clothing, footwear, accessories, bedding, furniture, jewelry, beauty products, and housewares. These are few of Macy's key competitors, and as we can see, JCPenney is one of them. Now let's start with JCPenney. So JCPenney Company Inc. is doing business as JCPenney and it's a department store. It is currently operating in 49 US states and Puerto Rico. JCPenney's product offering is pretty similar to Macy's. But in addition to selling the conventional merchandise, JCPenney stores often house leased departmental stores such as Sephora, Seattle's Best Coffee, salons, optical centers, pottery studios, and jewelry repair. These are few of JCPenney's key competitors.
Now coming to the timeline. Macy started as a dry goods store in NYC in 1858 by Hussey Macy. Macy's, known as Federated Department Store, was established as a holding company in 1929. In the year 1930, Bloomingdale's from NY joined the Federated Holding Company. The company acquired Atlanta's Rich and also Dayton before it went public in the year 1992. In 2005, Federated began operating under two national store brands, Macy's and Bloomingdale's. In the same year, Federated merged with the May department stores, and more than 400 former May company stores were converted to Macy's. In 2007, Federated was renamed to Macy's. 2015, Macy's acquired Bluemercury, a luxury beauty products spa retailers. This was the most recent acquisition. In 2016, to improve cost efficiency and processes, Macy's announced consolidation of its existing stores to 5 regions and 47 local districts. Coming to the timeline of salient information of JCPenney. In 1930, Penny incorporates his company consisting of more than 34 stores as JCPenney Company Inc. and moves the headquarters to NYC. In 1929, the company went public with a listing on NYSE. In 1997, the company acquired Eckerd Corporation and its 1750 drugstores for $3.3 billion. In the following year, JCPenney also launched its website. 2000 was a very important year for JCPenney as it launched a $488 million restructuring program that aimed at generating annual cost savings of about $120 million. In 2002, JCPenney changed its corporate structure to a holding company format and changed its name to JCPenney Corporation and became a wholly owned subsidiary of a new formed affiliated holding company. In 2014, the company opened its first store in Brooklyn, further strengthening its presence in NY.
Hi, my name is Neha and I'm going to talk about business drivers, business risks, and summary of earnings calls. Let's get started with Macy's. So Macy's is the most digital savvy department store with digital IQ higher than most of its competitors. Also, to streamline their portfolios, Macy's closed around 66 stores in 2016 and they plan to close around 34 stores in 2017. Moving on to JCPenney. So, improvement in JCPenney earnings was driven by higher sales and improved operating margins. Also, their turnaround strategies, which included focus on driven brands and omnichannel capabilities. Also, JCPenney has been experiencing strong same sales in all the regions. Let's talk about risk factors. So, Macy's is facing risk due to lack of concrete growth strategy to improve their performance in coming years. Also, their inability to accommodate customer preferences in their growth strategies. Let's talk about JCPenney's risk factors. So, JCPenney is majorly facing risks due to decline in gross margin, which is due to their aggressive aggressive promotional activities and increased couponing. Also, they are facing risks due to importing merchandise from abroad. Let's talk about earnings call summary. So, according to Q4 earnings call of Macy held on February 21st, the company ended 2016 with 2.9% decline in store sales, while their digital sales continued to be strong with double-digit growth. Sales transacted in stores continued to be below than what was expected. In 2016, Macy's do not expect any improvement in the sales trends related to 2016, but the impact due to less margins from sales is assumed to be offset due to the administration cost reduction that was announced last month. Let's talk about JCPenney's earnings calls. So according to Q4 earnings calls of JCPenney held on February 24th, the company delivered positive net income for the first time since 2010. Though their .com business is continuously growing, overall gross margin results for the quarter declined 100 basis points due to aggressive promotional activity and couponing. In 2017, JCP plans to restructure internal pricing strategy. Let's talk about executive compensation summary. So both the companies, JCPenney and Macy's, provide mixed compensation to all the executives, which includes base salary along with stock options and management incentive plans. Thank you.
Let us now look at the analysis of Street's position and the recommendation of the analysts. The consensus forecast among 23 polled investment analysts covering Macy's advise investors to hold their position in the company. This has been the consensus forecast since the sentiment of investment analysts deteriorated in October 2015. The previous consensus forecast advised that Macy's would outperform the market. In 2017, Macy's reported a dividend of $1.49, which represents a 7.18% increase over the last year. The analysts covering the company expect dividends to be $1.57 for the upcoming fiscal year, that is an increase of 5.39%. Macy's also reported fourth quarter earnings of $2.02 per share. This was in line with the consensus of the analyst following the company and underperformed last year's fourth quarter result by 3.35%. Macy's also had a revenue of $25.78 billion. This was 4.08 below the prior year's result. The last quarter's earnings per share was $0.37 and the current earnings per share estimate was $0.53. That is a 30% decrease over the previous quarter. Now let's look at the JCPenney. The consensus forecast amongst 26 polled investment analysts covering JCPenney advised that the company would outperform the market and hence an overweight Street's position. This has been the consensus forecast since the sentiment of investment analysts improved on July 5th, 2016. The last quarter earnings per share was minus $0.19 and the current earnings per share estimate is 0.07. That means a 136% increase over the previous quarter. The current year earnings per share is 0.49 and the next year's earnings per share is estimated to be 0.6. That means a 22% higher than the current year estimate. The analyst offering 12-month price targets for JCPenney have a median target of 8.25. The median estimate represents a 31.8% increase in the last price of 6.26. The result was also in line with the consensus following the company and exceeded last year's fourth year results by 64.1%. The next year earnings announcement is expected on May 11, 2017. JCPenney reported annual 2017 earnings of 0.08 per share on February 24, 2017. And JCPenney also had a fourth year quarter revenue of $3.96 billion.
Now coming to the horizontal analysis of balance sheet of year 2015 and 2016 for Macy's and JCPenney, we see that the total assets have decreased for both of the companies from 2015, but the total liabilities has increased in the case of Macy's and decreased in the case of JCPenney, which is a good sign for JCPenney. Now coming to the horizontal analysis of income statement of the year 2015 and 2016 for Macy's and JCPenney, we see the total revenue has slightly increased for JCPenney and for JCPenney, also there is a positive growth in the gross profit from the previous year. But whereas in the case of Macy's, both have decreased. Both the companies see a decrease in their net income, which is not a good sign for both of the companies. Now coming to the vertical statements of analysis. Now coming to the vertical analysis of balance sheet of both Macy's and JCPenney. Now firstly, vertical analysis is used to see the relative proposition of account balances. For Macy's, looking at the assets, we see that the ratio of cash and the inventory ratio has gone down, and the net receivable ratios has gone up. Total liability has increased, and equity, on the other hand, has decreased. Therefore, and similarly for the case of JCPenney, we see that the inventory and property and equipment ratios have gone up, but the total liabilities have also gone up from 2015. The shareholders' equity ratio has fallen for JCPenney. Now coming to the vertical analysis of income statement, we see that the cost of revenue has increased for Macy's and decreased for JCPenney, and the gross profit has decreased for Macy's and increased slightly from 2015 for JCPenney. Net income has increased for JCPenney and decreased for Macy's. Therefore, this is what is the result of the vertical and horizontal analysis performed on the two companies, Macy's and JCPenney.
Now let's start with a summary of ratio analysis for 2015-2016. The asset turnover ratio for JCPenney is 1.28, while that for Macy's is 1.29, which indicates that both the companies have managed to use their assets efficiently to generate sales. The inventory turnover ratio for JCPenney is 3.01, while that for Macy's is 3.02. So both the companies have done a good job at managing their inventory. The debt to equity ratio for JCPenney is 3.67, while that for Macy's is 1.8. So this indicates that the debt to equity ratio for JCPenney is almost twice of Macy's. And one of the reasons for this is because JCPenney has had to borrow a lot of funds due to the continuous losses that it has been observing from the past couple of cycles, and it deployed the borrowed funds to basically keep its operations going. The current ratio for JCPenney is 1.67, while that for Macy's is 1.34. So this basically indicates that both the companies are in a good standing to take care of their current liabilities. Quick ratio for JCPenney is 0.54, while for Macy's is 0.37, which basically says that JCPenney has 54 cents of cash for every $1 of current liability, while Macy's has 37 cents of cash for every $1 of liability. Moving on to return on asset. The return on asset for JCPenney is minus 0.05, while that for Macy's is 0.05. So this basically indicates that Macy's is definitely better at utilizing its assets than JCPenney. Return on equity for JCPenney is minus 0.32, while that for Macy's is 0.26. So it basically indicates that lower net income has resulted in the lower return on equity for JCPenney. The profit margin is minus 0.04 for JCPenney and 0.04 for Macy's. So which basically says that JCPenney has lost 4 cents of cash on each sale, while Macy's has made 4 cents of cash for each sale. The operating margin for JCPenney is minus 0.07, and that for Macy's is 0.075, which indicates that JCPenney has lost 7 cents of cash, 7 cents of operating margin on each dollar, while Macy's has made 75 cents of operating income or margin on each dollar. Moving on to the summary of ratio analysis for 2014 and 2015, the asset turnover ratio for JCPenney is 1.11, while that for Macy's is 1.31. So, which indicates that Macy's has done a better job in managing its assets efficiently as compared to JCPenney. The inventory turnover ratio for JCPenney is 2.86, while that for Macy's is 3.07, which indicates that though the inventory turnover ratio for both the companies is good, Macy's is doing slightly better. The debt to equity ratio for JCPenney is 2.78, while that for Macy's is 1.36, which again indicates that JCPenney has a higher debt ratio or a higher debt proportion. And the reason for this is losses and need for pumping funds into its operating activities. The current ratio for JCPenney is 2.01, while that for Macy's is 1.69, which indicates that both the companies have good financial standing to take care of their current liabilities. But JCPenney has a better current ratio than Macy's. The quick ratio of JCPenney is 0.78, while that of Macy's is 0.62. So, which basically says that JCPenney has 78 cents of cash for each current liability, while Macy's has 62 cents of cash for each each $1 of current liability. Return on asset is minus 0.06 for JCPenney, while it's 0.07 for Macy's. So Macy's is definitely better at utilizing its assets as compared to JCPenney. Return on equity is minus 0.29 for JCPenney and 0.22 for Macy's. So it's the lower net income which is affecting the return of equity on JCPenney. Profit margin is minus 0.06 for JCPenney and 0.05 for Macy's, which basically indicates that JCPenney is losing 6 cents of cash on every dollar, while Macy's is making or earning 5 cents of cash every dollar. JCPenney's operating margin is minus 0.021, while Macy's is 0.0996, which indicates that JCPenney is losing 21 cents of operating margin on each dollar, while Macy's is earning 99.6 cents of operating income on each dollar. Lastly, receivables turnover ratio. The receivables turnover ratio for JCPenney in 2015-2016 is 62.66, while that for Macy's is 55.15, which indicates that JCPenney collects its receivables about every 62.66 days. Every 62, JCPenney collects 62.66 times a year, while Macy's collects it 55.15 times a year. And for 2014-2015, JCPenney collects its receivables 67.16 times a year, while Macy's collects it 65.21 times a year.
Coming to the investors' decisions, we studied the EPS, PE, and the payout ratios. The EPS ratio of JCPenney has been negative, but we see a stark progress in the year 2013 to 2014. And whereas when we compare the EPS ratios of Macy's, we see a decline in it year after year. Coming to the PE ratio, a higher PE ratio signifies an anticipated higher growth in the future. The graph below shows the money investors are willing to pay per share earnings for Macy's is getting lower, but the trend is negative for JCPenney. Payout ratio is the most important metric used to determine the company's dividend payments. We see that JCPenney has suffered a decline over years, and same is the case with Macy's. Macy's seems like a better buy on paper, considering the above ratio value. However, ratio values alone are insufficient to make an investing decision. If we look at the corporate strategy, JCPenney is currently in turnaround mode. JCPenney over the years seems like have continuously increased its sales and has cut down its SG&A expenses. Meanwhile, Macy's sales have reduced year over year. Macy's is trying to unburden itself by closing 15% of its store base and has assets logged in real estate estimated at $21 billion, which is close to double its market cap. Although the assets give investors some relief, Macy's doesn't have a concrete strategy to uplift its business. The company has to work hard to strategize a new business plan and give its customers a reason to come back. Therefore, considering the potential growth in JCPenney's core business, it may have a better future, and it would be wiser to invest in JCPenney over a longer period of time than that of Macy's.
Now let's look at the creditor's decision for Macy's and JCPenney. This section will focus on the analysis of financial statements to decide whether to lend money to the company or not. This analysis is based on the following factors. First is earnings of the company. Second, how quickly are the assets liquidated? Third, previous liabilities. And fourth, how fast does the company pay to its creditors? As we can see from the table, for JCPenney, the ratio of company's debt to equity is 1.81, higher compared to Macy's, which is 1.589. That means JCPenney has more debt than stakeholders' equity than Macy's, which means JCPenney's creditor can get back more than Macy's creditors on liquidation. Next is the analysis of liquidity ratios, current ratio and quick ratio, as a determination of company's ability to pay off its short-term debt obligations. As JCPenney has higher current and quick ratio, it is better capable of paying back its short-term debts. Next is the financial leverage ratio, which determines how much capital comes in the form of debt and assesses the ability of a company to meet financial obligations. As we can see that JCPenney has high financial leverage than Macy's, which implies that JCPenney can get debts easily as compared to Macy's. Based on the financial statistics provided, JCPenney and Macy's are companies who find themselves on similar financial turf. Their value ratios are almost identical and fall in line with the industry averages, but JCPenney is expected to see more positive growth in future. The numbers say that JCPenney is in a better retail stock right now and is the safest addition to the portfolio due to its strong momentum going forward. So it is slightly better to lend in JCPenney as compared to Macy's.
Now coming to the conclusion, Macy's and JCPenney are both top premier retailers in the United States. But in the recent scenario, both of them are struggling. JCPenney's earnings per share is projected to see a year-over-year growth of 32.54% for the current quarter and 104% for the entire year. JCPenney is expected to see a positive growth in the future and as well as has a realistic business strategy in place to achieve their goals. Macy's, on the other hand, is in a tough spot with EPS fallen over more than one-third for the first 3 quarters of the year. They also have closed nearly 100 stores to revive the value locked in their real estate. Macy's EPS estimated year-over-year growth is minus 33.3%. Therefore, if someone has to invest, we think as a team that it should be JCPenney that the person should invest because of the reasons mentioned above. Thank you.